Carlson. He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And
Hey Ben, you muted your mic. To kick off the show. To kick off the show, you muted your mic.
I blame you for getting me a new microphone. Welcome to Ask the Compound. On today's show, we are tackling questions about the $6.3 trillion in money market funds and if it will put a floor under the stock market. Why would someone tie up their capital in CDs when there's so many other options for short-term cash? How family trusts work. We got a little bit Royal Tenenbaum situation going there. Financial planning for a loved one with cancer. And then paying off your student loans with the 401k loan. Remember, if you have a question for us or email here, askthecompoundshow@gmail.com. Duncan, I think we need to get a new highlight of me for the intro because people are going to think I'm a one-trick pony here. Just doing the same thing over and over again.
Well, you supply it. I'm happy to make it.
All right. You know, my mom is actually in the highlight, too.
For real?
She, had my jersey on and kind of did one of these. Yeah, she's trying to steal my thunder, I think.
Nice.
All right, let's do a question. Oh, wait, sorry. Today's show, sponsored by Public. Go to public.com/ATC to learn more about the Public Bond Account. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. With a minimum investment of just $1,000, you can invest in a portfolio of 10 investment-grade and high-yield bonds. Now, I know a lot of people on this show are very big on individual bonds. They want to hold their individual bonds and potentially hold them to maturity. That's what this portfolio is. It's 10 bonds, corporate bonds. You can lock in a potential yield right now of 6.8%, which is the average yield of maturity for this portfolio. Listen, some investors find comfort in the idea of holding individual bonds, not a bond mutual fund or ETF. And I get the psychological benefits there. So with a public bond, or the bond account at Public, you can lock in higher yields now before the Fed cuts rates. Only takes a couple minutes to get started. $1,000 minimum investment, not too bad. So take a look for a public bond account or go to public.com/ATC to learn more. That's public.com/ATC.
And I feel like this is a good time to mention part of the reason that we might seem like we're running around and a little hectic today is we just finished with having Josh on CNBC here in the studio, and so it's a tight turnaround. So I think a good time to mention that we're going to be moving the show to a new day here in a few weeks.
Make it easier on the production staff. Speaking of football, Josh was talking to Al Michaels on CNBC just before us. I saw it.
That was cool. Yeah, he was.
Yeah, we're going to be going at the end of the month. We got one more week on Thursdays, and the end of the month we're going to be moving to Wednesdays at 1 p.m.
Yep.
So if you're a live viewer on YouTube or Twitter or now LinkedIn, we're trying today, which I didn't know was a thing. You can watch this live on LinkedIn.
Yeah.
We're all over the place. We're
everywhere.
Spraying and praying. All right, let's do a question.
Okay. Up first today, we have a Twitter question coming in, or X, depending on what you want to call it. I have a stock market theory. The large amount of cash in money markets, high yield savings, etc., means that a down day for the S&P will quickly be reversed by buying the dip, and this will continue until cash balances drop significantly. Thoughts?
Good idea. We've been talking about this a little bit on Animal Spirits in recent months with Michael and I. There is a lot of money sitting in money markets right now. John, throw up the chart. $6.3 trillion, and you can see how much an increase there's been just since the pandemic. So that's pretty much double what there was pre-pandemic. And it makes sense when you think about it, right? The Fed jacked up short-term interest rates. We're talking excess of 5% for most money market accounts. Long-duration bonds have much higher interest rate risk, and when rates rose, those bonds got crushed. So money markets were essentially a win-win for people. John, you can do chart off. So you had volatility suppression, you had higher yields than bonds, and you had liquidity. Like what else? That was an easy decision for most investors. I think a lot of people that listen to this show have been asking, call it money markets, CDs, high yield savings accounts, whatever. So So the question is, what happens when the Fed starts cutting rates? Because yields on money markets will fall commensurately, and they'll fall pretty quickly. So it's possible the Fed could cut rates quickly. We're looking at maybe 100 basis points by the end of the year. So we're talking that 5% goes to 4 really quick. If the economy continues to slow or the Fed keeps cutting rates because inflation is falling, we could see 3% if we go into recession. I don't know, 2%. So it's a fair question to ask, will this cash on the sidelines find its way into the stock market? So let's start with quantitative analysis first, then I'll move into some quantitative stuff. So John, throw up a chart here. The Federal Reserve has quarterly data on money market assets going back to the mid-'70s because that's when money markets were first started. I looked at the change in quarterly money market assets along with a corresponding quarterly return for the S&P. And I'm looking for a relationship here, right? Does a down stock market mean more money's coming out of money markets and potentially into the stock market? And you can see here we tried to draw a trend line, but let's be honest here, there's no trend in place at all. And in fact, I looked at the returns in the down quarters, and you were twice as likely to see money go into money market funds than out of money market funds when the stock market had a down quarter. So it's not like in the past investors have used money markets as a form of cash on the sidelines. What about yields? Okay, how about yields falling? So when the yields fall, investors must be taking money out of money markets, right? Because it's not as attractive. Here's the next chart. Our chart kid Matt did this for us, and you can see he highlighted all the times when money market yields have fallen since 1989. And in 3 out of those 4 times, or 4 out of 5 times, money has gone into money market funds as yields fall. And you think, well, that doesn't make any sense. It's a lower rate of return. But why do yields fall? Typically, it happens because of a recession. And guess what happens? People get scared. Assets coming out into the great financial crisis, 2005 to 2009, rates were falling from money markets. Money was going into that. Same thing happened during the pandemic. And I'm actually surprised. John, throw that chart back up real quick. You can see money market assets fell a little bit following the great financial crisis and stagnated, but that's because money market yields were effectively zero, and you were paying fees on these things. So I'm actually surprised that the assets in money markets didn't fall more during that time. So it's nice to assume that like investors will be chomping at the bit to put cash to work when yields fall or when the stock market falls. But guess what happens when the stock market falls? People get scared. What happens when we have a recession? People get scared. So they put more money into cash, which seems counterintuitive. So what happens the next time stocks fall? Will this happen? It's possible. It's also pointing out that money market funds are pretty new still. So money market funds didn't exist till the mid to late 70s. Banks used to cap the amount of interest they could pay, and that goes back to the Great Depression. Here's a little history lesson for you, Duncan. Banks couldn't afford to pay a lot of the interest that they were putting on these savings accounts and money and bank funds back in the day. So one of the rules that they made out of the Great Depression was you can't pay over a certain amount of interest. And no one ever thought rates would get as high as they did in the 70s and early 80s. So when those rates started going up and you couldn't earn those money market rates, someone actually created this mutual fund structure for money markets in the mid-70s. And so a ton of money flowed in the 70s and 80s. So it's kind of hard to say in the 80s if it really makes sense to compare it to the stock market because it was such a new fund category. I think the other part of the equation is how much of a boost did money market funds come from bonds? So John, throw my last chart up here. This was the bond bear market we've talked about here a lot. Long-term bonds got crushed. They're down almost 50%. But even 7 to 10-year bonds were down, 24%. The ag was down 20% almost. So I would venture to guess a lot of the money that went into money market funds, a portion of those trillions of dollars came from bonds. And so when money market yields fall, I think there's a better case to be made that money will go into bonds as opposed to stocks. Plus, you have the baby boomer aspect of this. And baby boomers are retiring, 10,000 baby boomers retiring every day from now until the end of the decade. Millions of baby boomers are already retired. People don't want or need to take as much volatility or risk with their portfolio when they're retired. So I think a lot of that money could actually be kind of sticky in fixed income. So it's not necessarily going to go back into the stock market. Some of it probably will go back into the stock market, but I don't think that cash on the sidelines is going to provide a buffer or a floor to the stock market. I think that's wishful thinking.
So that's all great, but people just want to know what should they buy with the upcoming rate cut. What do you buy?
What do you mean, what do you buy? You're looking for like a stock pick here?
Anything, how do you invest with an impending rate cut?
All right, how about this? Do you need to change your portfolio at all? That's the thing that hurts most investors.
You always have the most boring answer to these questions where I'm trying to get you to...
Because investing should be boring. Do you need to change your portfolio? Just everything is going to be moving and changing all the time. Maybe your portfolio shouldn't be. Unless
I'm the person,
circumstances change.
I see that article pop up, I click on it immediately. how to invest in a rate cutting cycle, I click on it.
Listen, I think you can weigh your options and your risk and reward, and I think most people probably over the past year or so should have been slowly but surely moving back into bonds, and I think you still have some time there if you want to get out of money markets, because if we go into recession, I think bond yields are higher, and you're going to get a nice little bang for your buck if rates continue to fall. So I think a lot of people have been using cash and fixed income as a bond proxy, and so I think that's the easiest thing for most people to do is just move it into some other form of fixed income where unfortunately you're going to have to take a little more risk than you have in the past 24 months or whatever.
Okay.
Someone says in the chat that I'm a broken record. Hey, listen, this record's just fine. I'm not broken at all.
You're a record on repeat.
That's a saying that should probably go away anyway. My daughter has a record player in her room just of all the Taylor Swift albums. But I mean, I know it's kind of made a comeback, but
like actual vinyl. Taylor Swift on vinyl.
Yeah, she has Taylor Swift vinyl.
Nice.
That's a true fan right
there.
I
like vinyl. I'm a fan.
All right. Next question.
Okay, up next. This one dovetails nicely, and I have some follow-ups on this too. So from Twitter, another serious question. Why would anyone take out a 5-month CD with high-interest savings accounts at the same rates and liquid? Tax ramifications? I have the same question and some follow-ups, but yeah.
Legitimate question. Now, not even getting into the taxes, the simple reason here is reinvestment risk. So the Fed is going to cut rates next month. Again, they could cut. So a CD, so they're showing a 5-month CD here. The beauty of this is you're locking in the rate. And guess you still have reinvestment risk when that CD matures, but you don't have reinvestment risk next month when the Fed cuts, and then maybe the following months when the Fed cuts again in your money markets. Because guess what? Your high yield savings account will go down. And unfortunately, I like to view high yield savings account kind of like gas prices. When oil goes up, it feels like gas prices go up even more. And when oil goes down, it feels like gas prices fall less. I feel like that's the same thing with high yield savings account. When interest rates go up, they don't go up as much anymore. And when interest rates go down, the high yield savings account yields don't go down as much, or they go down further, I should say. So I actually pulled some CD rates from Marcus, where I have my online savings account. And so John, throw up the chart here. I had Sean, our research guy, plot the current CD rates from Marcus, which is the Goldman Sachs personal finance account, and then compare them to U.S. Treasuries of the same maturity. Now you can see here, Duncan, CD yields are higher than U.S. Treasury rates at 6 months, 1 year, 2 years, 3 years, and 5 years. This would seem to not make any sense. Why should they be offering a CD to you at a higher rate than U.S. Treasury? What's your answer, Duncan? Do you have one?
Trying to just bring you in as a customer?
Good guess.
Loss leader?
No, it's because the liquidity. Well, so two things. Liquidity is first. With a treasury, you can take it out and sell it, and it's one of the most liquid markets in the world. But with a CD, you have no liquidity. And if you want liquidity, John, throw up the next thing. This is from Marcus here. It shows what happens when you take money out early. So if you take money out a year, 1 year or less, you get dinged 90 days of interest. If you have a CD term that's 5 years or more, you get 270 days of interest. So that's like 3/4 of a year of interest on the principal balance that's taken away. So if you want to take that money out of the CD, the beauty to the banks of the CD is that money is locked up. So if you want it early, there's no liquidity, you have to pay a penalty. So that's why those rates are higher. It accounts for the liquidity. But it's still, I still think, 4% 5-year CD is not a bad deal, actually. If rates are going to be falling, I don't know what rates are going to be in the future, but that to me seems like pretty decent. You can get 4.7% for a year if the Fed cuts rates and they're down at that level. So obviously the CD rates account for where they think rates are going to be in the future a little bit. That's why they go down as you go further out on the risk curve. But that's the whole point, is you're locking it in.
Okay, so that answers the question I had for you about why, for example, on public, if you're buying their treasury product versus their high yield savings account, why the high yield savings account's paying more. It's because you're locking the treasury account in for longer, and the high yield savings account will be cut immediately, basically, whenever there's a Fed cut. That's
Bingo. So that's what makes short-term fixed income instruments way better in a rising rate environment, because those yields roll over quicker, and you're going to get the higher yields faster, and you have interest rate risk when yields rise, but it's the opposite when yields fall.
Okay.
So, yeah, that's the whole point. You're going to get,
that makes sense.
And you're going to get more bang for your buck if you're in like a bond ETF and rates keep falling and we go into recession or whatever, then you're going to get some price return as well.
Okay.
There's all these trade-offs. That's the whole point, though, is that there's risk and reward and there's trade-offs.
Right. Well, just seeing that high yield that draws people in, right? So yeah, having the context, understanding how that works is helpful. And now
No free lunch.
There's no like rule or anything. The bank or whoever is providing the high yield savings account, they don't have to adjust, right? They're just doing it because otherwise they'd be losing money or not profiting as much, right?
Yeah, well,
it's not like it's tied together.
Right. A lot of the high yield savings accounts, when they first came out, they would offer this 12-month grace period where they're offering a higher than market yield, and they're essentially paying you and they're eating the costs just to get new people in, so they think you'll stick around.
I did that twice, and both of those banks failed.
Yeah, funny how that happens. Still can't believe you invested in a place called Zerp. It literally sounds like an SNL skit.
And Enzo, like Ferrari. That was cool. I like those.
All right, next question.
Okay. Up next, we have a question from Nick. I'm the fortunate beneficiary of 2 trusts set up by my grandparents. I was unaware of the first trust until I started receiving K1s in my early 20s. No income, just a K1 and a tax bill. This past year, I turned 30 and received an additional K1 for a GST I'd never been made aware of. Again, with taxes due. My father is both the trustee and the managing member of a perpetual LLC in which both trusts bear an interest stake, comprising 100% of the trust's property. The LLC was created years after the trust. I had to pull teeth to get the trust and LLC agreements and have read through them multiple times. Both trusts state distributions shall be made to the beneficiary at ages 30, 35, and 40. And the LLC agreement states that all income shall be distributed each year to the members. Thus far, I have received no distributions. Most of my inquiries to my father have been ignored or deflected, making things increasingly difficult. I don't mean to laugh, but I was telling Ben, this reminds me of Royal Tenenbaums. It really does.
It really does. It really does.
Something
It sounds
that would be
like
a Wes Anderson movie. All right, part 2. How would you advise a client to navigate this principal agent problem, especially when the trustee is a family member? Is there a conflict of interest in this structure, and how would you approach it? It could be that distributions result in an individual stake in the LLC, but having estate planning tools invested in a perpetual LLC with next to 0 distribution rights to the members seems like it nullifies the intention of the trust.
I thought like Knives Out a little bit, but you said Royal Tenenbaums. Just before we bring our expert on to help answer this one, I know you have to like Wes Anderson because you're a film guy, and film people have to love him, but let's be honest, he hasn't made a good movie since Royal Tenenbaums.
Oh, well, that's not true. I mean,
I'm sorry.
Moonrise
Bottle
Kingdom,
Rocket, Rushmore, and Royal Tenenbaums were all great movies, and he hasn't made a good one since, and they're unwatchable.
Grand Budapest, Moonrise Kingdom, both very good. Fantastic Mr. Fox was good.
It's a love it or hate it kind of guy. I'll say that.
I don't love them all. I'll be clear about that, but yeah.
All right, so let's bring in our estate planning expert, Taylor Hollis, to help unravel this here.
Hey, Taylor.
Hi.
Taylor, I'm curious. You've worked with a lot of trusts and estates over the years. How often have you experienced family infighting on these types of deals? Does this happen all the time, or is this pretty infrequent?
I wouldn't say it happens all the time, but it is, when you mix money and family and layer it in with some, legal requirements, like it's kind of a recipe for some conflict. There's a lot to unpack in this question. We could probably do a whole episode on this question. And Ben, since you brought up the family dynamic, I'll, address that first. He asked about whether there's a conflict of interest. It's not unusual for a family member to be a trustee. So conflict of interest, it depends, and it's hard to say without knowing everyone's role. Like, is the dad also a beneficiary? Is, this guy the only beneficiary? There's a lot of questions, but I do want to preface this entire answer with speak to an estate attorney, right? Trust and estate laws governed by individual states. So depending on what state you live in, if you really have strong concerns, which based on the question, I think it's warranted and might be a good
yeah. So if the dad keeps ignoring and deflecting, talk to a lawyer is probably his best bet.
Yeah.
Right.
What if his dad's a lawyer?
Find a different lawyer to talk to.
But I suppose the whole thing here is just control, right? The dad probably assumes, listen, I'm the elder statesman here. I'm taking control. Sorry, you can have control when I'm gone or something.
And I can understand, though, I don't know anything about trust, so I'm learning a lot today. So trustee means the person that can control the trust. Is that correct? And then, what would be the point of a trust that's not actually paying you anything? That's what I'm a little confused about. He's saying he's not getting anything from the trust, correct?
Correct. That's what he's saying. All sorts of different roles. It offers protection from creditors. Maybe the intent of the trust is to grow the assets instead of distributing income. All of that's governed. A trust itself is fully governed by the document. So whatever's in there should be what's followed by the trustee. He had some questions about the structure of the trust owning the LLC interest. That's not uncommon. We see that a lot. And likely that's the result of some advanced estate planning. There are times we recommend that for some of our clients as well. So I don't have as much concern over that, more as I think the concern of the transparency of information, if he's a current beneficiary, is worth talking to an attorney about. Beneficiaries are usually entitled to receive information.
So if the dad ends up dead for some reason, the FBI may come calling us and say, hey, who sent the email? Right?
Oh, no. Joking. Just kidding.
Okay. But to your point, the document is the thing, right?
Yeah.
Basically, the document and a lawyer, that's your first path forward here.
Yes. Yeah.
Okay.
And I'll say he's right to have questions. Like what he told us in the question, he's right to ask.
Sounds fishy. Duncan thinks that I just somehow like
you're trying to turn us into
myself.
Knives Out. Let's not have a real Knives Out situation.
It is a good movie.
Yeah.
All right, let's do another one.
Okay, up next we have another long one, two-parter. Not sure if you want to bring up a downer question on your show, but my wife has just been diagnosed with pancreatic cancer. She is young and very healthy. From everything I've read, I think we have a good chance to make it through with some hard work. We have a will, healthcare directives, and I'm set up as her power of attorney. We are setting up a beneficiary trust for our son in the event we both were to pass away. She is a stay-at-home mom, so we're not too concerned with her employment. We have a good healthcare HSA with over $40,000 dedicated to it, and I have a good job that is supportive of everything we're going through. She's 40 and I'm 48, and we have a net worth of over $2 million. The only real debt we have is on a 2.75% mortgage, but that debt is under $100,000, and I could pay that off with my emergency fund. Second page. We have a life insurance policy on me and never did one for her since she was going to be covered if I were to pass away. I currently have a high-stress job that takes a lot of time for my personal life. I could have to work over a weekend on the flip of a coin if something comes up. We've been able to balance it fairly well with the support of my wife. The question I have is, what am I missing? I know we can beat this and things will be okay moving forward, but now this has happened. I am reviewing everything to try and validate the plan moving forward if the worst comes up. Since I'm 8 years older than her and I figured I would most likely pass away first, I never considered something happening where she had to leave us first. Is there anything that we're missing for the worst case scenario? So right. sorry to hear, but
yeah, first of all, that's a crappy situation. Doesn't always seem fair. I think the thing that we realize in the financial services industry is that you can't shy away from uncomfortable conversations on occasion, right? We've dealt with death and divorce and illness and job loss. And unfortunately, you don't want, the last thing you want to worry about in those situations is your finances. But you can't also just hope that the finances won't be a sticking point. So I guess the whole thing here is hope for the best, but plan for the worst, right? And I agree with him. The baseline assumption probably for most people usually is, especially if you're older, but most, female life expectancy is longer. And so, and if he's the breadwinner of the family and she's a stay-at-home mom, it sounds like they did most of the stuff they should do. Is there anything else he can do just to make sure those ducks in a row, if whatever happens, either way, that what can they do here?
Yeah, I want to definitely applaud, the position he's taking and the optimism and their desire to be prepared, already way ahead of the curve on that. I think, they've already done a lot of good work setting up the will, having the powers of attorney in place. That's a good baseline everybody should have those, but especially when you're entering a situation like this. Things that stood out to me on this question, at the end, he asked, what am I missing? I understand the setup of, she's a stay-at-home mom, he's the breadwinner, alluding to his, pretty demanding job. While she doesn't have employment income, I would look at, if she weren't here, the cost of childcare, right? There's a value to what she's doing. And if she were gone, if he's still going to work his full-time job, he would have to, address, right?
I was going to suggest they should probably get a nanny now. If they have a net worth of $2 million and he has a high stress job that sounds like it's also high pay, and she's going through an illness and probably getting treatment, I think having some childcare now would be very helpful, just to see yourself through the situation.
Yeah. Again, not a doctor. We've talked about this before. But stress exacerbates medical issues. So yeah, anything that they can do to help with their.
I think that would probably hopefully
good.
alleviate some of that a little bit. Yeah.
Agreed. And then from an estate planning perspective, I'm sure they've addressed this already, but naming a guardian for their son, now that obviously comes into play if both are gone. But having that discussion together, I think is really important. And
that's always my wife and I have had those conversations. We have it on paper now. It's a very uncomfortable conversation to have, and you feel weird, like you're picking a favorite among family or friends. But again, these uncomfortable conversations, you sometimes just have to have them.
Yeah.
Especially in this kind of situation, pushes it to the forefront where you can't keep putting it off. You have to do it.
Exactly. Right. And then in that same, along those same lines is have the discussion. Again, these are tough conversations, but what are their mutual wishes for their son, right? So,
True.
If she's gone and he's raising the son, what are some things that are important to her for her son, right, as he grows up? Those were the three things I think that mostly stood out to me, but just a very tough situation. So,
and it sounds like they got some of the big things covered already. Like you mentioned some things that are helpful, but I think they're doing okay.
Yes, absolutely.
Yeah. So anyway, crappy situation started here. We're okay taking downer questions here. Obviously, it's we're okay having those uncomfortable conversations, but that's a crappy situation we're going to go through.
Good attitude, though. I think the positivity is only going to help.
Yep.
Yeah. All right, we got one more.
Okay, last but not least, we have a question from Claire. My wife and I are in our 30s and still have $25,000 in student loans at about 10% interest. I'm wondering if it's smart to take a 401k loan where I will pay myself about 9% interest, somewhat offsetting the opportunity cost of missed returns. The money comes out of my traditional 401k tax-free and went in tax-free. I do have to repay with after-tax money, but if I were to liquidate something else to pay for this, I would also owe taxes on that. I don't think I'm at risk of being laid off, knock on wood, so having to repay it immediately hopefully won't be a factor. So to me, it's would I rather pay myself the interest or someone else over the next 3 years? I don't understand this at all. Hopefully you guys can, I can't be alone, explain this.
Well,
you can pay you give the interest? You pay yourself interest?
I do feel like sometimes people say that as a way to talk themselves into this. Technically, yes, you're paying yourself, but I think this is making things far too complicated than they need to be. What do you think, Taylor?
I agree. I mean, you just look at, like, if you boil it down to just the rate arbitrage there, it's 1%, right? If you're looking at what you're owing on the student loans and what you'd have to pay on the loan, and a 1% margin is just very thin for trying to thread the needle like this and doesn't offer you much flexibility. Heaven forbid you are laid off, then
the knock on wood's not going to help in that situation.
Right. This whole thing blows up.
It's not like you're gaining much from this.
Right. Pause your 401k contributions and increase your payments on your student loans, depending on, if you have taxable money set aside, can you liquidate some of that at a low tax cost to pay it off, and even the 9% rate on the 401k loan, it's something, but you're missing out on maybe 20+% years, right?
Yeah, and compounding. Yeah, you're missing out on the compounding. It sounds like, oh, this is easy. Why wouldn't I just do this?
Yeah.
To your point, whatever you're putting into a 401k, I don't know, keep getting the match maybe, but then put anything over and above that into the student loan and pay it off a little quicker. That makes more sense to me in terms of interrupting the 401k rather than taking out the loan, putting yourself at risk, because after you take out that loan, you have regular payments to make on the 401k loan that, so you're essentially swapping one piece of debt for another. So it doesn't really make that much sense to me.
Arbitrage. And something we haven't mentioned yet is look into refinancing the student loan. I mean, I know rates are high right now, so I don't know if you could do much better than 10% in the private market, but it's worth looking. And certainly if rates go down, I think you take that.
So to complicate that calculus a little bit, how long would you say is okay to quit contributing to your 401k if you have a lot of student loan debt and you're trying to pay it down?
I mean, the interest rate certainly is a piece of it. 10% is a lot. If I'm getting up my soapbox real quick, I can't believe anyone pays 10% interest on student loans. It's insane to me that we have allowed this system to offer people that loans that high. It seems ridiculous to me. So that's part of the equation. So I guess at 10%, I would certainly make it a priority. I don't think it has to be the priority. I still think you can kind of split it up, like I said. Maybe keep getting your match, and then anything over and above that goes in to pay off the student loan. I would certainly look, like Taylor said, into refinancing potentially and seeing what other options are out there, because 10% seems egregious to me.
Yeah, these are definitely not government loans, right, at 10%, because I think mine are like 7% through the government. So these must be private student loans, right?
Yes,
guessing.
I don't get how the government has allowed these rates to be this high. It just it makes no sense to me.
Yeah.
That's
another question we could spend a whole episode on, probably.
Yeah.
Yes,
yeah,
but I think keep it simple. Don't try to swap the 401k loan for the student loan. I don't think it's worth the risk you're putting yourself under just to save a little bit on interest. I don't think it's worth it.
Agreed.
And who knows? Maybe one day they'll lose all the paperwork for all these loans, and
Well, that's maybe the other thing is some of it'll be forgiven somehow, right? Or so, yeah, that's possible.
Yeah, true. A lot of people are probably taking jobs in the public sector just to get the public student loan forgiveness, right? That's a pretty serious benefit if you have massive loans. Probably not the 25,000 level, but
I was in the nonprofit space for 10 years, I think, I think I just barely missed it or something. I didn't stay long enough in the nonprofit space to make it happen. My student loans had already been repaid at that point.
Wow, almost made it.
I took one for the team.
Yeah, good for you. You know, the government needed that money anyway. So.
All right. I want to thank Taylor for coming on and helping us with a lot of paperwork, and I think number 3 could be a movie still.
I like it. Yeah. And very, very good writer. That question was written really well.
I'll work on the script. Duncan can do the cinematography.
Yeah.
All right. Remember, if you have a question for us, our email here is askthecompoundshow@gmail.com. Leave us a comment on YouTube. Thanks for everyone watching live on YouTube, LinkedIn, Twitter. We appreciate it. Subscribe, rate, review, all that good stuff, and we will see you next time.
And see you at Future Proof.
Yep.
See ya.